Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Thank you for all the comments and suggestions on what stocks to do next. I greatly appreciate the feedback. This channel is dedicated to rational investing, and what we mean by that is we have 5 principles with which we use to evaluate every stock, and we try to use those principles to figure out what is the intrinsic value of the company. We then look at what we think the stock price should be, what's it trading at, and if we think we can make a return over the long run. This channel is dedicated to the buy and hold investor, the investors that have daytime jobs and don't have time to sit at a desk and day trade. Well, what we look for is 5 key attributes. The first one, we always look for top-line revenue growth. That's a hallmark for a good investment. EBITDA growth, strong EBITDA performance. EBITDA is our enterprise-wide earnings. We look for strong free cash flow. We look for a solid balance sheet, and we look for a well-priced stock. The well-priced stock being the hallmark of buying a good investment. I've worked with many private equity groups in my history of my financial career, and all the time they will constantly tell me that they would much rather have a company that's trading dirt cheap than paying 1,000 different analysts to come up with prognostications about the future, because inevitably they're always wrong. But if you buy the company cheap enough, you can kind of weather whatever storm you have. So definitely check out my Domino's versus Google IPO, where I compare the 2 IPOs of the companies 15 years ago and what the returns have been today. It will shock you to learn that Domino's has beaten Google if you bought the IPO. But enough about that. Let's dive in. Today, what we're going to look at is Cisco, the giant infrastructure network company that is out there, that is evolving its business model. And I want to take a look at the numbers and see what we think this company might be worth, how much cash flow it produces, what we think the value might be. Put aside the stock market for a second. Just what do you think the value might be of this company? Then let's go look and see where it's trading and figure out what the value, the economic return might be if we hold it for over a decade. Okay, let's dive right in here. There's a couple things I want to point out in the balance sheet and on the business model first. Behind me is the 10K. 10K is the annual report. You can get that from the SEC's website. If you Google SEC search, it'll pop up. You can find anything disclosed by, well, not anything, but all the public disclosure that companies have to file on a regular basis. That is on that website. You can also typically go to a company's investor relations page and download this material as well. Cisco, their financial fiscal year ends in July, right there, July 25, 2020. So when I show you numbers, it'll say 2020 year. That I'm representing the fiscal year end 2020 for Cisco. And this is their 2020 annual report. It's as of the 12 months ending July 25th, 2020. So just a frame of reference. This isn't calendar year, this is fiscal year. But let's move forward. One of the things I liked in particular was in their disclosure, the evolution of this business, the transformation of the business model, which I think is really key. And I highly suggest going through and reading the annual reports of companies that you invest in or you're interested in. Don't be too eager to go diving in randomly in a stock just because someone says the quarter was good. Read the 10K. Go back and read a couple 10Ks and see how it has evolved over time, how management's thinking has evolved, and you'll be rewarded for that. Here, they're actually talking about moving their business from a product sales focus to a subscription model business, which is really, really interesting and would give them a lot more value as a public company, given the multiples that SaaS companies trade at versus product sale companies. I think that's a significant upside for them. Conversely, it's going to take them a little while to get there. If you look at some people who have done it in the past, like Microsoft, Adobe, and so forth, that have gone through the one-time sale business model into a software of service model, they go through something called swallowing the fish. And it's a term that was coined by a book called Subscribed. I'll put a link in the description to it if you want to go check it out. It's a good book. It basically walked companies through how do you go through a product sale a company business model into a subscription model, and that takes some time. And when that does, you're essentially trading today's sales for future sales. So you're going to see revenue drop initially before it climbs back up. So you get the fish shape with the tail coming down and then the body as it grows up like that. That's why it's called swallowing the fish. It's like you have to swallow a whole fish. But in here, it talks about what they're doing to move their business over to a subscription model. If you go read the latest 10Q and some of the presentations, they talk about their service business and how fast it's growing relative to the other business, which I think is really attractive. I also think there's big plays here for 5G and some of the other network capabilities that they're rolling out. Let's see what that looks like in the financials and see if it's priced well. Okay, behind me, 8 years of financials for Cisco. We're going to go through it and see if this meets our 5 key attributes for a solid investment. We'll then kind of theorize on what we think the value might be going forward and see if we like it. First of all, once again, reminder, 2020 here, this is fiscal 2020, so ending July 25th of 2020, the previous 12 months. They booked $49 billion of revenue. And I was actually surprised reading this, that's a 1% growth rate over the last 8 years. It's really, really not much. That's even below inflation, certainly inflation. Well, yeah, no, that's below inflation during that period of time. I think it was about 1.5% a year. So they have really struggled, and this is barely meeting our first criteria, which is revenue growth. Technically it is because it's not zero, but it's nothing to write home about. I certainly wouldn't pay much for it because it's essentially, they haven't been able to grow their revenue. EBITDA has grown. You can see EBITDA has grown at 2.8% over the period of time. Again, pretty lackluster if you ask me. 12.6 billion to 15.8 billion. I'm hoping that part of the weak growth here is them converting their business model over to a subscription. So I think you got to give them a little bit of credit for that and watch that piece of their business, the service business, and see if it grows. But that might be what we're seeing here is that initial drop as they exchange today's sales for future revenue streams under the subscription model. So that's EBITDA and that's revenue. Technically both checking the box for growth, but it's super meek. Let's look at enterprise value, debt levels, kind of begin to get a rounded picture of what the enterprise looks like. Debt, 16 billion to 14 billion. It's come down, kind of spiked up about the 33 billion. It has come back down. So they've definitely been chunking down the debt recently, which is a good thing to see. I was shocked to see the level of cash that they have on their balance sheet. That's excess cash. And I'm pulling the investment line that they have on their balance sheet under current assets. So it's a current asset, meaning it's less than 1 year maturity of an investment, which is essentially cash for our purposes. And when you look at this, you look at least current year, they've got $17 billion in cash. Kudos to them, by the way. 14.5 billion of debt. They could easily pay off all of their debt with the cash on hand and still have enough cash to run the business. So really, when you look at this business on a net debt basis, it's zero. So that's debt minus cash on hand. Market cap is share price outstanding. I'm using the end of the fiscal year, and I'm using shares outstanding, and I get 100 billion to 194 billion dollars of enterprise market cap. I add debt to market cap, subtract the cash, I get an enterprise value here, 75 billion to 200 billion, 190 billion. What does that look like on a debt basis? Like I said earlier, EBITDA divided by debt. So I'm taking EBITDA divided by debt. That is our risk. That is our judge for financial strength, right? That's the risk of bankruptcy would be one of many measures, but this is a very important one because EBITDA is the earnings with which they use to pay debt. And every year they have to make a debt payment. And the more times this has to go into the debt, the harder it is for them to make the money, the more to make the payment, the greater the risk of bankruptcy. So we look at this as a balance sheet item and one of our cornerstones that needs to be under 3 times. Here, when I do the net debt formula, it's 0, which is fantastic to see. The next thing we look at is pricing. So when I talk about a price of a stock being expensive or cheap, I don't mean the actual price in the market, $1,000, $500, $20. Who cares? Really, it is How much is that price relative to earnings, relative to the cash flow that I'm going to get out of the business? That is what I mean when I say cheap or expensive. And you can measure that here by EBITDA multiple. That is the enterprise value, which we just calculated here. That's enterprise value. That's all common stock, preferred stock, which they have done, and they have, and debt, the whole enterprise, divided by EBITDA or earnings for the entire enterprise. And you can see here, it was as low as 6 times EBITDA. That is cheap for a business of this size, and it has come up as the general market has come up. It's now trading at 10.5, but that's with the current market price. It's just for us to note here. But really, when you're looking on an annual basis, last fiscal, it traded at 12 times earnings. So you can see the range that this stock has traded between, pretty low. I think it had very low expectations, the market rather, had very low expectations for this company if it's willing to give it a basically single-digit EBITDA multiple for the last 6 years. That's 2012 through 2013, basically paying no attention and writing it off. That seems to me it's really cheap. One note for us value hunters, right? When we identify a stock that we believe is super cheap, and we're waiting for the market to realize it is cheap, look how long you have to wait. This is 6 years. If you would have bought it in 2012, you're still holding on. You got a nice bump recently, right? Because it's gone from 6 to 12, so you've doubled the multiple of the earnings. EBITDA's roughly flat, so you've doubled your share price, which is good. But you had to go a long time before you got any return. So I would caution people on patience. Just because we believe the market is undervaluing a business doesn't mean right when you put your money in, the market's going to realize it, it's going to revert north. That typically never happens. People tend to wait 2 to 5 years to fully realize a value of their investment. So I would caution you just diving in thinking it's going to revert. In this instance, it can stay there for a long time. But eventually they did get the rise. You can see these years here, it got a step up in multiple, basically the doubling of a multiple. It's then come back a little bit, it's 10.5, which I think is a very reasonable price, very reasonable multiple to pay for a company whose revenue and earnings are barely growing. But if it's not growing because they're swallowing the fish and they're converting to a subscription multiple, then it's cheap. Because subscription multiples, can trade 20, 25, 30. I mean, some of this stuff that we're looking that I've shown this channel, 50 times, right? That's 50 times would be 5 times the value of this company. So instead of $200 billion, right, of enterprise value, it'd be it'd be $1 trillion company. So that is a huge, huge move. No reason to believe it's going to happen tomorrow, but if they can continue to make strides converting their business over to subscription model and prove it out, they should see revenue growth again, they should see earnings growth, and the fact that earnings is subscribed deserves a higher multiple. But for now, it's 10. Let's go look at cash flow and take a look to see if cash flow is jiving with the income statement. Okay, cash flow. My favorite statement of all, cash flow from operations. That is the first third of the cash flow statement, 2012 to 2020. Again, this is through July is the fiscal year. Again, fiscal year, not calendar year. And it's grown 11 to $15 billion. That's a 4% growth in cash, which is roughly in line. I think the EBITDA was 2.8, so round this up to 3, right? This is 4. So cash flow from operations is growing in line with EBITDA, which means the accountants are expensing what they need to expense when it comes to cash items. And that is critical, especially in this day and age of a super robust stock market. People get away with a lot of stuff, a lot of glitz and glam. People buy into that without actually smell checking the numbers. And it's good to see that it's happening here. The smell check, not the glitz and the glam. Okay, CapEx has come down over time. They're making other investments. It's not exactly CapEx, but it has come down, and that has pushed more money into free cash flow. Let's talk about the debt for a second. Okay, so here it looks like they're borrowing money. It's positive. It's debt coming into the business. That's the way you look at this. And then on the back side, it's negative, so it's flowing out. And this corresponds to here on the debt statement. You can see debt peaking at 33 billion. So it's building up here. They're drawing in cash as they're borrowing more. It peaks at 17, and then they've been paying down the debt since then to 14 billion, and it's actually less than cash on hand. So that's what you're seeing here, the pay down. I add these up, these three, in this instance way down here, I've got $15 billion for cash flow from operations, less the $770 million, which is very low CapEx to maintain this cash flow. It's incredible. $10 billion of debt payments leaves me $4.5 billion of free cash flow to operations. Shares, $4.2 billion, which is basically then $1.06 of free cash flow. Average share $4.46 gives me a 2.3% yield. Now I'll take a pause here. This is technically the way to do it, but I want to talk about the debt for a minute. We said earlier that they have enough cash to pay off the debt, but in the cash flow statement, we're still subtracting the cash flow from the debt. And what I want to do is I want to make a small change because I think this is underrepresenting how much cash they actually generate. If they were to take the cash on the balance sheet and pay off the debt, these debt payments wouldn't be there, right? Historically, this debt wouldn't be there. If they had paid off all the debt, and again, just looking back here, this is the debt, this is the cash on hand, right? So it's slightly, cash is always more than here. So 37 billion, 25, 21, 24, that's close, 17, 14. So they could liquidate the debt. They chose not to. They're making payment, but I think these payments are largely arbitrary because they choose to have it. It's a management decision. So what happens if we remove this? And that's what I'm going to do. I'm going to take away the debt payment because in reality, they don't have to make the payment. They could choose to make the payment. And what that does is it moves up the yield. Now our yield is 7.74, 7.75, almost 8% or 7.5% yield, which is extremely strong for this market to have a business with no debt that's yielding cash. My point here, and I'll get to it, sorry, it's belabored. My point here is that they're choosing to carry a little bit of debt, but they don't need to. And in terms of the amount of cash that the business generates, I don't want to count the debt because they could pay it off. And in the future, if I'm using these cash flows to forecast in the future, I don't know what their capital structure is going to be, and they might choose not to have the debt. So I want to be buying cash flow that I think I'm going to buy. I'm willing to underwrite the 7%, which bumps average free cash flow per share, right? $2.73 to call it $3.50. That's a strong cash flow per share. And I want to take this average here, I'm going to move that forward when I forecast. Are you with me? So all I'm doing is just backing off the debt in the cash flow model because they have enough cash on hand on the balance sheet to zero it out. All right, let's move forward. Forecasting. All right, so I pick up 2021 being a forecast of 2020. I'm growing it at 2.8%, which is what they've been doing historically. If they're able to kind of swallow the fish and grow that software of service, then kudos for them. It's all upside to us. But I don't have to bake in a huge kind of hockey stick growth curve in order to get the return that I need to get out of the stock. I want to be super conservative, have a company that's making 7% cash, has a 3% growth, and still pencil out on an IRR. That would be amazing. If that happens, that means that if they beat the forecast, which is pretty low, then all the upside is I get to keep. I did not have to pay for it. And that's what I'm looking for. And it's rare. You have to look a lot to find it, but this is what we're going for. So I take the average per share cash flow previously, and I grew it at 2.8%. I get $4.25 10 years from now. I applied a 5% yield to that, and I get $85 in stock price. I do the same forecast for EBITDA, growing EBITDA at 3%. Again, if they accelerate that, fantastic, but I'm not willing to underwrite that. right? So that puts an EBITDA forecast out there in 10 years of $20 billion. I give that a 12 times multiple, which is a low multiple. If they actually turned into a software subscription company, well, I'll do that in a second. So that gives me a $250 billion enterprise value. Again, I've got less debt plus cash, which is more cash than debt. Gives me a market cap of $285 billion. Less shares outstanding give me a $67 price target. So now we have two targets. We have one based on a free cash flow where they've delevered the balance sheet, they cleared the cash, they're just a dividend machine, and that is a 7% yield. It grows at 2%, and in the end, I get an $80 stock price out of that. Versus the other way, EBITDA market multiple approach, where they keep the capital structure the same, they just continue to equal on 2%. I get a 12x multiple, which is reasonable. They were at 12x just last fiscal year, so I'm not growing the multiple. And I get a $67 price target. That's pretty neat. I average the two, so $85 here, $67, average $67. It's currently trading at $40, which is a nice deal. Let's plug that into the IRR calculator. So here I get $40, I get a stream of cash flow, which again is unlevered cash, assuming they'd paid it all off. And I get an average price at exit of $67. And in the end, that gives me an annualized IRR of 16%. That is an annual return. That's not total return like over the decade. That is every single year you have averaged 16%, which is going to be, that's an outperforming stock. If you look at the returns of the S&P 500, people are saying 10%. It's done 10% historically. That may or may not do that next year, but this is saying 16. That's good without a huge growth rate. That's even better. We're not relying on market multiple expansion. We're not relying on high growth. It's just kind of doing what it's doing, which is nice to see. Let's see, the other thing I wanted to do is we're going to turn this off. So I'll turn off the free cash flow, and we're going to rely 100% on the market multiple and just see what does it look like if you expanded the market multiple. So just as a benchmark, that's now 15% because I'm only relying on the $67 exit price. Nothing else has changed. But let's assume they get their software subscription model done. I'm not going to change the growth forecast, but now that earnings is now subscription earnings, it's not individual sales, so it deserves a higher multiple. Let's give that 20 times. It's probably pretty rough. Let's go 18. We'll go 18. That's a $100 stock price. All right, let's put that $100 into the IRR calculator. There you go. So if that happens, then you're making 19% on your money every single year going over that decade, which is it's much higher than the 16%. And that is kind of the upside, an example of upside that you could get that you don't have to bake into the forecast. You don't have to price that in today. So I'm just going to reset just so we've got, oops, the wrong button. I'm going to reset just so you have that done. So we're back now to our 16% IRR. We said, look, that could be some upside all the way to 19, so that's an extra 3 turns of IRR, or 3 extra points percentage onto your IRR. I'll put this into a forecast for you. So our current price is 40. You think I've already done this and been prepared, but I'm not. Forgive me. So here's our 16% that we said for $40 stock price. That's what it's currently trading at. If it were to decrease to $36, the IRR, assuming the same $67 forecast forward, we're not doing the high EBITDA multiple, but just the same forecast, your IRR goes up to 18. If it comes down even further, it gets really attractive. If it goes up, it's still double digits. If you're buying the stock at $53, it's still a double-digit return, even if you've given away some of the upside. It's still a great stock. So I think let's recap where we are here. So we've got the 5 key attributes for Cisco. So top-line revenue growth is very weak. Agreed. EBITDA growth, also weak. Technically, they meet. So it's kind of a pass. I'll give it. Debt is extremely low, so it's a safe, good balance sheet. A free cash flow is strong, especially when we remove the debt. You got a strong yield, so you can kind of sit back, collect your dividend, which isn't all that 7%. I think the dividend yield is around 3.5%, 4% now. So you're just getting paid to wait. And then last is well priced. At 10 times EBITDA currently, I think it's a strong, at a very attractive price, and I think it's got some upside. So us at the channel, we're going to give it a good. We think it exhibits all 5 attributes, and it has some good upside that's not priced into the stock right now. So I think this is a good stock to venture in if you're looking for exposure into the infrastructure area for IT. Okay, let me know what you think. Love to hear the feedback. My name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing, and have a great day. Bye-bye.